hate to break it to you, but the average 30-year mortgage in the United States just surpassed 7.6%. This is bad news. This is the highest level we've seen since December 1st, 2000. So it's fair to say, our current economic situation is getting dangerous. Investors all over the United States are wondering how it's even possible that this market hasn't already collapsed. What started as a mild annoyance has now grown into one of the worst asset bubbles in finance history, just waiting to pop. But how did we get here, and why are things so bad? If you stick around, I'll explain everything and clear up all your confusion. And at the end of the video, I'll give you my best recommendation to help you weather the storm. The housing crash that's coming will be the worst we have ever experienced. And to show you why, let's take one step back into history to look at clear evidence that what is happening today is far from normal. A lot of people will show you charts like this to model the housing prices in the US throughout history. But this chart has one severe flaw. It doesn't factor in inflation. Over a 50-year period, inflation has a powerful effect on the value of the dollar. And misleading charts like this overlook these effects entirely. For example, if someone tells you, I bought my 3,000 square foot house in 2001 for $220,000, you might think they got a great deal. And when you realize that their home is worth $350,000 in 2023, you might even get jealous of their $130,000 gain. But you just made the same mistake as the silly chart I showed you earlier. Because $220,000 in the year 2001 is worth about $382,000 in today's 2023 dollars. So while on paper, this person is up in his home, they actually lost money. Think of house prices like a roller coaster. Over time, the price of houses can go up or down. To truly see if houses are getting too expensive, we use a tool called the Inflation-Adjusted Case-Shiller. This tool helps us see the real price of houses without being tricked by other factors like a changing dollar value. Right now, this chart is showing us that houses are more expensive than ever before. In fact, they're even pricier than in 2008, which was a year known for crazy high house prices. In fact, based on the pioneering research of Robert J. Shiller and Carly Case, we have relatively good data on housing prices going back to 1889. And as you can see, 2008 was absurd. The price of a home reached a level that was previously believed to be impossible to reach. And while there has been a trend of growing real prices in the last 100 years, it's still clear that today's bubble is now worse than what we saw in 2008. This span was considered normal, but since about 2012, we've left all sense of normality. So what makes me think that we'll end up back here? It starts with a bit of history. It wasn't really all that surprising to see the 2008 bubble start to develop after the year 2000. The reason for that was interest rates. Throughout history, interest rates have been high, at least when you compare them to modern standards. For the last 30 years, we've had a slow decline in rates. This enabled the ingredients for the 2008 bubble to form and collapse. But unfortunately, this wasn't enough to teach the Fed a lesson. Because even after the 2008 bubble, the Fed continued to suppress rates at new records. They pushed them down to 2.6% at one point, and of course, this created a new bubble from late 2011 to today in 2023. The real price of a home, meaning the inflation-adjusted price, rose 66% outside of the 2008 rise. This country has never seen a rapid acceleration like this. And each time it's happened, we witnessed a crash to bring this phenomenon in line with the historical average. Now, if you look at this chart and still don't believe me, there is another crucial piece of evidence that, in my opinion, is the nail in the coffin. It essentially proves that something in the market must give to bring things back to normal. Before I explain this, do you mind hitting that like button? This will help the video reach a wider audience so I can help even more people. And it also supports the channel. I would greatly appreciate it if you just took half a second to gently tap the like button. Back to the video. First, let's understand how the housing market and interest rates work. The price and demand of houses can be affected by interest rates. Think of interest rates as the cost of borrowing money. When they're low, it's cheaper to borrow, which can lead to more people buying houses. Next, let's look at how most people buy houses. Most people don't buy their home with cash. Instead, they borrow money using a loan, and the most popular type of loan is the 30-year fixed mortgage. The name comes from the fact that the interest rate doesn't change, and you pay it back over 30 years. Without diving too deep into this topic, we know that the interest rate for the 30-year mortgage is influenced by something called the 10-year Treasury. Think of the 10-year Treasury like a guide. If its rates go up or down, the 30-year mortgage rates often follow in the same direction. In short, the 10-year Treasury helps set the cost or rate for home loans. If it becomes more expensive to borrow from the Treasury, it'll often become more expensive for people to get a mortgage to buy a house. Now the question is, what does this have to do with my home and its value? Well, to answer this and finally put the nail in the coffin, we have to understand a bit of context. Think of a 10-year Treasury note like a special kind of paper that the government uses to borrow money. And the way they do that is pretty simple. They take your cash with a promise that they'll give you the money back with a little bit of interest after 10 years. Currently, the interest rate they are paying is 4.5%. Now, here's where it gets interesting. There's also a 2-year Treasury note, and if you look at that one, the interest rate they're paying is 5.02%. This means that the government is paying you a higher interest rate to borrow your money for 2 years instead of 10 years. This is strange because normally, it's the exact opposite. Typically, the government wants to incentivize you to let them borrow money for a longer period, so the longer you let them borrow money, the higher the rate you receive. But when the rates are inverted like this, you get something called an inverted yield curve. Long story short, inverted yield curves are the most obvious signal for a recession. In fact, the yield curve has only had one false positive since 1955. This happened in 1966, when there was an inversion of the yield curve that was not followed by a recession, according to a 2018 San Francisco Federal Reserve Bank report. However, if you look at this chart going back to the late 70s, every single time the line went below zero, which signals an inversion, what followed was a recession. This was true in the early 80s, early 90s, early 2000, 2008, 2020, and now. If you zoom in, you can see the problem. This chart is from 2022, so it doesn't show the new developments. But essentially, we have gone even deeper in the inversion and are now starting to come back up. Now you might think, well, we're coming back up, which is good news. Maybe we've managed to avoid the storm. But this couldn't be further from the truth. With the inverted curve we are seeing, this means that the chances of a recession are nearly 100%. The worst, and really when the recession typically starts, is after the inversion is complete and the line moves past zero into positive territory. Just take a look at 2008. It was only years after the inversion that the real pain began. Right now, we have a situation that's extremely troubling. The Fed is pushing rates to the tipping point, but the bond market is calling their bluff. And this is my final point when it comes to a future crash. Did you know that in the current market, the 30-year yield is essentially the same as the 10-year yield? This odd similarity in yields is making investors nervous. Usually, a 30-year loan should have a higher yield than a 10-year loan because it's riskier to lend money for a longer time. But right now, they're the same, which is unusual. Based on how these treasuries are behaving, investors think inflation will keep rising. If the Fed is raising rates to control this inflation, but then suddenly stops and maybe even lowers them, it could mean they're responding to some crisis or big economic problem. In essence, the way these treasury rates are behaving is like an alarm bell, warning that the economy might face some challenges ahead, especially with rising prices across the board. Imagine you've built a giant tower of cards, and one card slips. The whole tower comes crashing down. That's the situation with our housing market. We're on the edge of a big change, and it's like we're stepping into a mystery zone. If things go wrong, the economic crisis we've seen in the past 120 years will seem tiny in comparison. So, what does this mean for everyday people like you and me? If you own a house, your monthly payments might shoot up due to rising interest rates. Many homeowners will struggle to keep up and may have to sell their homes for way less than they're worth. For those who invested in rental property, hoping prices would always go up, they're in for a rough ride. They could lose money through depreciating property prices and could also see a significant drop in rental income. But with all this bad news, I have some good news. If you're stressed about the recession, don't be. Not only can you survive this recession, it could be the best money-making opportunity you've ever had. So watch the video on your screen to learn how you can use the 2024 recession to pay off debt and finally get rich.